Welcome to The Explainer. Today, we're diving into one of the absolute most fascinating corporate mysteries of the year. We are tearing apart a massive, incredibly high-stakes transformation over in the life sciences sector. The company in question is Waters Corporation. But as you'll soon see, the company we're analyzing today is completely different from the one that existed just a few short months ago. Okay, let's dive into this. Over the past year, Waters stock has surged an incredible 51.55%. But here's the truly wild part. To put that into perspective, if you had bought this exact same stock 5 years ago, your total return up until recently, just about 2%. No, really? That is a massive, sudden disconnect in the market. So this begs the ultimate question, doesn't it? Did Waters fundamentally change overnight, or is Wall Street just aggressively betting on unproven hype? I mean, are investors buying a genuinely evolved, highly profitable company, or are they blindly throwing cash at a massive integration project that still has a whole lot to prove? Stick with us, because by the end of this explainer, we're going to earn our definitive verdict. Section 1. The Transformation. Creating a new life sciences giant. To really get what's happening here, we have to rewind to February 2026. That was the exact moment Waters officially ceased being just a legacy analytical lab tech company. They closed a massive combination with Becton Dickinson's Biosciences and Diagnostic solutions businesses. And look, this wasn't just some casual bolt-on acquisition. We are talking about a staggering $18.8 billion transaction. You don't drop nearly $19 billion just to add a new product line to the catalog, right? You spend that kind of money to completely rewrite your corporate DNA. Because of this massive deal, we're no longer looking at the old Waters. The company completely reorganized into 4 brand new distinct divisions: Analytical Sciences, Biosciences, Advanced Diagnostics, and Material Sciences. So we are officially investigating a brand new life sciences giant. Let's trace how this actually played out. When the deal officially closed in February, the market kind of panicked. Shares actually fell 12% intraday. Investors were essentially standing there with their arms crossed saying, okay, prove this $18.8 billion gamble is actually worth it. Well, Q1 2026 rolled around and Waters absolutely delivered, posting a massive $1.267 billion revenue beat. And by Q2, that number ballooned to $1.645 billion. The market's initial skepticism just rapidly turned into extreme optimism. Section 2. The Contradiction. Unraveling the earnings mystery. Now, what's really interesting about this slide is exactly how that $1.645 billion in Q2 revenue breaks down. Both business engines are pulling massive weight here. We've got $828 million from organic Waters revenue, which, by the way, grew 9% in constant currency. And right beside it, $817 million from the newly acquired businesses. So the acquisition isn't just sitting idle, it's actively driving incredible top-line growth. But here is where things get super tricky. Waters reported a Q2 GAAP loss of negative $1.39 per share. A year earlier, they were completely profitable. However, if you look at their adjusted EPS, it actually grew 3% to $3.05. This massive, glaring gap is driven by heavy acquisition-related accounting charges. Basically, it's the massive on-paper cost of stitching 2 giant corporations together. So the real question we have to ask ourselves, putting on our pro-investor hats for a second, is this: how much of this accounting damage is just temporary paper losses, and what is the real lasting economic cost of merging these massive entities? After all, you have to remember, those on-paper numbers stem from a deal that cost very real, very hard cash. Section 3. The Integration. 180-Day Growth Revitalization Plan. Management absolutely knew they had to prove this deal could work, and work fast. So they launched an aggressive 180-day growth revitalization plan for the new operations. And you know what? The early results are incredibly promising. The acquired Biosciences and Diagnostic businesses accelerated toward mid-single-digit growth, hitting roughly 4% in Q2. And the legacy Waters business? Actually, scratch that, they didn't just not drop the ball, they crushed it, delivering 8% instrument growth and double-digit growth in chemistry consumables. The turnaround is clearly working on both fronts. But look, revenue means absolutely nothing if the cost to generate it eats up all your profits. So our next big question is, can Waters grow its top line faster than its ballooning integration costs? They're carrying massive new overhead right now, so managing those synergies and cost actions, that's going to be the ultimate test of their margins over the next few quarters. Section 4. The AI Catalyst. powering precision medicine. Now, let's pivot to a major catalyst that has investors absolutely buzzing right now. In June 2026, Waters announced a strategic partnership with IMU Biosciences, and this brilliantly illustrates what the partnership actually does. IMU is using an AI-powered platform to map the human immune system. We are talking about analyzing over 100 million data points from just a single blood sample. To do this at a population level, they're relying on Waters' advanced flow cytometry technologies, like the BD Fax Discover. It is literally a perfect marriage of heavy-duty biological hardware and cutting-edge machine learning. But as wildly exciting as that sounds, we have to avoid the classic investor trap here. An AI partnership does not automatically equal immediate AI revenue. Let me repeat that. It does not guarantee immediate cash. This incredible technological potential still needs to thoroughly prove its commercial viability. We have to watch for measurable demand, not just lazily assume it's going to instantly pad the bottom line. Section 5. The future. Pricing imperfection. With all these moving parts, the mega merger, the massive revenue beats, the flashy AI partnerships, Wall Street is looking straight to the future. Following Q2, management actually raised their full-year guidance, expecting 10 to 12% adjusted EPS growth. And the market heavily rewarded that optimism. With the stock trading near $410, it's sitting very close to its 52-week high. But guys, this changes the risk profile entirely. At $300, investors were betting on a potential turnaround. At $410, investors are no longer betting. They're paying a premium for flawless future execution. Looking at this objectively, there are 3 distinct ways this investment could go sideways. Step 1, integration. If those synergies fail and costs stay elevated, growth will absolutely stall. Step 2, valuation. Even if they execute perfectly, the stock could still fall simply because way too much success is already baked into the price. And step 3, end market cyclicality. Pharma and lab customers don't spend in a straight line. If research budgets tighten up, expensive instrument purchases get delayed. It's just how the industry works. Section 6. The final verdict. Earning our conclusion. We've laid out the entire mystery. We've seen the $18.8 billion gamble, the confusing gap between GAAP losses and adjusted profits, the promising 180-day turnaround, and this high-flying stock price. So the crucial point is right here on this scorecard. The fundamentals are undeniably strong. $1.645 billion in Q2 revenue, 9% organic growth, and an upgraded EPS guidance pointing to 10 to 12% growth. But you absolutely have to balance that incredible execution against a stock that's already rocketed over 51% in a single year. Because of that massive free rating, our definitive verdict right now is a solid watch. We need to see them sustain this growth and truly master the integration margins before aggressively chasing the stock at these highs. I want to leave you all with this final provocative thought. The interesting thing about Waters isn't whether it can grow. The market already clearly believes it can. The real investment question is whether Waters can grow fast enough, profitably enough, and consistently enough to justify the massive premium price investors are paying today. Keep a very close eye on their next earnings report because this huge corporate evolution, it is far from over. Thanks for tuning into The Explainer. We'll see you next time.